Okay, let's bring in Brian Belski now. He's the Chief Investment Strategist at BMO. Once again, joining the conversation live today from Minneapolis. So everybody's bullish again, Belski? It's all good?
Well, the panel stole all my best material, so let's see if I can wing this here. Poor Mike Wilson. We've already beaten up him a little bit. I think if you take a look at this notion of a rolling correction, which you said on air that you agree with, how can we have a rolling correction, Scott, if the market's up 10%? You know, I learned the business 31 years ago from William O'Neill when I worked there at the firm and at Investors Business Daily. And a better way to kind of frame that, if he wants to call it a narrative, is rotational leadership. The best secular bull markets show this consistent rotation of leadership. I think that's a better way to say it. And I think someone else on the panel was talking about, I mean, it's nearly impossible to make short-term calls. So I'm not familiar with Mike's process or discipline. I just think it's really difficult to go even look back at 2018. You got to remember, 2018 was the tariff tantrum, and the Fed was going the opposite direction, raising rates. And for all intents and purposes, this is a short-term call for hedge funds. It's not a short-term call for people in mom and pop in Wilmer, Minnesota, where I grew up. This is for shorter-term momentum money. And I think the bottom line is this, Scott. The cyclical rebound that we've seen in stocks, part of a bigger secular 20 to 25-year bull market, which we've been calling for a long time, is in the transition of two things. Number one, it's becoming more fundamental and more earnings-driven. That's very apparent, and I think the panel agrees. They talked a lot about that. Number two, and I've heard a lot talk about this, is that we're returning to a stock picker's market. It's showing in a majority of the industries and sectors, in terms of dispersion of performance, dispersion of earnings growth, and dispersion of multiples. When you see such a wide dispersion, Scott, it really means that you have to focus less on the market in these big fancy market calls and more on being in the right stocks in the right areas, whether or not it's growth or value. And that's why we're broadly balanced across growth and value, small, mid, and large. I think that's going to be the right call for the next several years.
So do you think the worst of the correction, whatever you want to call what happened on Friday and Monday, is that now behind us? That was a period of quick volatility that now we've come to Friday and we hit new highs on the NASDAQ and the S&P 500 and all's fine again? The market's going to be able to look to the other side of this Delta variant because we may very well get to herd immunity as a result of it. It may be a painful period of time to get there, but we're going to get there. Is that what the market sees?
Yes, I think Jenny said it much more appropriately than I will, and most likely. But we have to cut ourselves some slack in society and our business. We have done an unbelievable job pivoting in our personal lives and socially in work to achieve what we've achieved as a society the last, let's call it 14 or 15 months. And with respect to herd immunity, I think it is of an amazing point. And look at where we are now versus where we were in February, March of last year. Lastly, fear and rhetoric and momentum still driving stock prices on a short-term basis. So a two-day correction is a two-day correction. But we'll have to see somewhere down the line that the market finally does see a cyclical correction based on fundamentals, Scott, not based on kind of fear. So with that, I think it's surprising to note that earnings numbers continue to go up. Everybody thought the market was earnings were going to peak. But if you look at over the last 1 to 3 months, earnings for 2021 and certainly for 2022 on a fiscal year basis are going up. And I don't think anybody imagined that.